I'm amazed how many people own stocks.
Welcome to the Playing FTSE podcast. My name's Paul, and each episode me and the lads get together to talk about the stocks, stock market news and finance in general. Quick disclaimer, you shouldn't consider anything in this podcast as personal financial advice. If you need such advice, go to a financial advisor. And please remember, when investing in any form, your capital is at risk. So sit back, relax and let the lads fill you in with all the stock market news of the week.
The sucker's going up.
Welcome back everyone to the Playing FTSE podcast with me, Paul Briscoe. We've got Zach, Steve W and Steve D here today, all to talk about the week in stocks. We're going to share some of the news that's gone on this week. There's some big news that's gone on, and then we're going to have a chat about stock, and we're going to probably end with a couple of our little favourites as well. Everyone had a good week. Has anyone been up to anything?
Yeah, I had a good week, especially in the stock market. I think some of us have had some astronomical gains.
To be honest with you, I have as well. I have been all over Bitcoin this week because the great Elon Musk has decided that Tesla needs 1.5 billion of Bitcoin, right? Yeah, adding 1.5 billion of Bitcoin to Tesla's balance sheet. Is this all just a massive PR stunt, or is there something more to this?
I mean, recently, because they've had a good quarter just gone. I think they said that they're basically using their cash to maximize returns that isn't required to maintain adequate operating liquidity. Basically, what they're trying to say is we're YOLOing, but we'll fancy the words up, and you guys have no idea what it means. I think because I had a good look, and I think that's around 7% of their cash that they're holding. So it is quite large. It's imagine 7% of your portfolio going into BTC, right? And you have no idea like what it's gonna do in the next week or the month after.
Believe it or not, I actually saw something on that today, and it's something like they've got 25 billion on their balance sheet, and they've decided to put 1.5 billion into Bitcoin, and it's not 7%. Mm-hmm. Jesus, Zach, it's not just 7%. It's actually 6.9%, which makes it obviously so much better, like because it's Elon Musk, right? Because this is not a PR stunt in any way.
Yeah, I mean, how much money have they made since joining the Bitcoin crowd? I mean, yeah, is it just a case of a taste for disruption and publicity here? I mean, a lot of including Chamath for one. I know we have Parik Patel as well.
Yeah.
I think it's just a case of publicity stuff here.
Yeah, it's there's a lot to it. I mean, this did start a long time ago when we saw the conversation between the guy from MicroStrategy. His name's just left the top of my head there, and they were talking about getting Bitcoin onto a balance sheet. And ever since then, it's kind of been on the cards that Tesla was going to take on Bitcoin, and we all knew what that was going to do. With Bitcoin, and now if we are to make a really good bull case for Bitcoin at this point, this has opened up corporations to now buy Bitcoin. I don't know why it took Tesla to do this rather than say Square or PayPal that have already done this, but now apparently Bitcoin is now open up to all sorts of companies. I mean, the latest one was Apple were talking about doing it, or at least someone's made up the rumor that Apple's going to take on Bitcoin. But actually, Salesforce seems to be one of the bigger companies that seems to be one of the ones that wants to take it on.
I'll go bigger. BlackRock. I think they've allowed their funds to take up Bitcoin as well. So this is just a case of how much can we push Bitcoin and make it institutionalized, I guess. And I think, as you mentioned earlier on, that fella who's had a seminar earlier this month, past month, Bitcoin rocketed as a result. I mean, I know a lot of the small cap stuff, including the miners, they jumped as well, quite a few. So it's just a case of, is it a self-fulfilling prophecy? I mean, should we pump it enough and eventually it'll become, the reserve currency?
Is that what it
people
craves?
think
Are
it's
we
gonna be?
craving some legitimacy? Is that what Bitcoin needs to be to become the reserve currency?
I mean, I'm a big fan of Bitcoin. I personally have been in and around that system since about 2010, and I'm pretty much part of the Bitcoin gang, really. Especially Ethereum as well. I'm a big fan of what Ethereum could be. So I always plan on holding a bit of Bitcoin. I've always said 1% of my net worth I'd like to put in Bitcoin as a hedge against the economy. So I'm more than happy to be currently 200-300% up on Bitcoin last time I checked anyway, because Bitcoin bounced 15% on the news of Elon Musk taking on it. But I did see today lots of other things to do with Bitcoin, like Michael Burry came out again, and there's something that happens when that guy starts to talk about shorting your stock. And he, as we all know, I think Michael Burry is well short Tesla at the minute, and so far I don't think he's lost anything on his Tesla short, as far as we know anyway. And he basically said that Bitcoin and Tesla are both going up at the same rate, and there's no other reason for them to be going up other than hype. And that includes Tesla, which I'm actually quite interested in Tesla, because even though it's way off its earnings, when you look at Tesla and its price to sales ratio, it's actually quite low. I think its price to sales ratio is something like 25. When if you compare any other company out there, like CrowdStrike, Salesforce, even Teladoc, I think their price to sales ratio is actually more like in the hundreds at the moment. So you could argue that Tesla is kind of right on value at the moment if you look at it in that way.
It's even cheaper, I mean, on price to sales ratio than Neo as well. I mean, a lot of people think Neo's cheap, but I mean, on that ratio itself, Tesla's cheaper.
I mean, I wouldn't be valuing either of those companies on price to sales, though, because they've got a high ticket item and which they sell a lot of, and it's profit that matters. It's profit that matters on a car.
Yeah, and also, while I haven't looked at this, I'm coming at this from personally quite a poor knowledge level, if I'm honest. Would their price to sales, would their sales revenue also include the green energy tickets as well? Would they be bolstered by that, do we think?
They split that out, don't they, usually? I think they split them out in the most recent figures. So I think we can safely assume that they will be in the main figures, but I think they are split out later down.
Yeah, because I know Neo used them favourably, meaning whenever it was best for them to kind of boost up their numbers. I don't know about Tesla, to be fair. But on your case,
it was just an interesting one, because I wondered if their price to sales, their revenue count, did actually include the green tickets or not. And if you are, then, because it does seem that Tesla right now is being valued on its price to sales because it's around 25 to 30. So if it's including these green tickets, I mean, it's not bad, because the green tickets aren't going anywhere. So there's no real reason why you should discount them. But it is that we're starting to think that even on price to sales, Tesla is a little bit too overvalued. And then you've got Michael Burry and his thesis on the stock and how the stock's moving, and he thinks it's bubbled over. He literally said that on Twitter today. He thinks that Tesla has now bubbled over and he's waiting for the crash. That's a big top to call, though.
Does it mean that he's indirectly kind of shorting Bitcoin?
Yeah, in a way. In a way, it's
I guess
it's there's a lot to it, isn't there? They are both they're both. He's saying they are both correlated. So yes, in that way, Michael Burry is talking right on about Bitcoin. On shorting though, I do want to move this on because I think we could just talk. I think me and Zach could talk about that for a very, very long time. On shorting, we've got to move on to the other piece of news that was pretty big this week, and that was the Hindenburg report on my favourite man, Chamath Palihapitiya. If anyone doesn't know, I'm not a big fan of Chamath. I think he's a bit of a Disney villain. My personal opinion is he's lying. That's my personal opinion. So do we think that Clover Health's time is over, or do we think Chamath can save it?
Well, this isn't the first time that there's been a short report on Clover Health, and out of all the short sellers, I think Hindenburg's probably the one I have the most respect for. They were the ones that called Nicola short. They were the ones that basically revealed about the truck rolling down the hill. So yeah, their report is really in depth, and it's some of the stuff in there is quite shocking. I think with a lot of short reports, you find some of the stuff is just like pie in the sky, like reaching for the stars, kind of. I've seen this guy wear the same shoes as this guy, so they're both liable. And then there's some parts of it that are, I was looking at some of the stats on the physicians from Clover Health, and they're way overstating the amount of physicians that are using the service at the moment. So it is quite shocking, really, some of the things that were revealed in there. And Chamath has just kind of come out and said, well, trust the process. Well, that's not how investing works. And SPACs are well known for fraud. And this, on the face of it, looks like it could be another one.
It's very much worth noting that Hindenburg isn't actually in a short position for this stock, as far as we know, either.
No.
Yeah, I was trying to work out what I want to see in a short report for these kind of things. I mean, whether I want a short report from someone who is short a stock, or whether I want to see it from someone who isn't. I mean, there's a certain sense in which when I read short reports, I tend to think, well, there's a chance this company's short this stock and are now trying to get out of trouble on their short report, which has been going up and up and up, and now they need to try and find some pressure downwards on it. On the other hand, I do also kind of think, well, if I'm reading a short report and there's not a reason why they can't, I would like to see them put their money where their mouth is a little bit on these kind of things, rather than just throwing mud from the side. So I'm always slightly wary of what I want to see in short reports from who's got what position in these sorts of things.
Didn't they spend like 4 months on this report and then basically just backed out last minute just because Citron is not doing isn't shorting anymore? I mean, but here's the thing now, because they're trying to position themselves as being, the superhero of the stock market, trying to call out the bad guys, right? Now then, why aren't they in a short position then? I mean, is it just a case that they don't want to be on the opposite end of the Wall Street?
I think there's two reasons why. I think
right?
One they explain is that they want to release the report to legitimise short selling in saying that, we're not short this stock and therefore we're not overstating the facts. We're trying to show you the benefit of having good quality short selling reports that are out there. But the second reason is that Chamath is man of the people at the moment, and the going short on a cult figure at the moment, which is what he is, that could backfire even if the facts are correct in the short report.
I agree with that. You definitely need the right kind of catalyst to go short on something. That's why people have been having such a miserable time shorting Tesla. You just don't stand in the way of something that's going up at a rate and shows no sign of turning. Even if you think it's overpriced, even if you think it's going to miss its earnings, you need some sort of really good catalyst to say, look, this is the point where it's going to turn around, rather than just keep driving straight through us in our short position and we're going to get burnt out.
There's an element of getting scared at, causing another GME, that sort of thing. But these guys do work really, really hard for their short reports. The Nicola short report was very, very intense. I think they ended up infiltrating Nicola and getting text messages, and that's how they found out about the rolling down the hill. These guys don't just turn up at a fake address and take a photo of it like we've seen in previous short reports. We've now got some of the things that they brought up in the latest Hindenburg report on Clover Health are, they're pretty strong, and there's no one more than me that wants to see Chamath eat some shit for a bit. I think he's really pushed people on the GME thing, and he's really good marketing and jumping on the bandwagons, and if there's a hole, someone's going to find it, I think, and maybe we're starting to see those holes. It would be nice to think that, but on the other hand, maybe it's squeaky clean and maybe it's perfectly right. But they're definitely overinflating the amount of physicians they're using, definitely, and they say that they're against these sorts of practices when the DOJ report does suggest that they are simply following the same rules, at least to get ahead in the short term.
I find Chamath kind of confusing. I'd be interested to sort of hear what Steve and Zach think of him. I mean, I feel exactly the same way that you do, right? And I think I can probably rival you for my general dislike of him, maybe slightly short. But I really find it hard to pin down why. Because when I try and pin down why, I've got, well, I think he lies to people quite a lot. I think he's a straightforward marketing kind of a guy. And I think what he doesn't care for the people he thinks he's informing and will cost them money as long as they buy his SPACs or generally do what he tells them to do in the markets. But that's true of like everyone in these market participation things. I mean, there's CNBC contributors who in one interview are telling you there is no point buying anything that doesn't pay a dividend. In the next interview telling you that their 3 biggest holdings are all SPACs. And then pushing Amazon and Facebook and Alibaba for another one.
But it's when you do it off the back of being an ethical person, right? Because that's his whole thing. That's what social capital is all about. He went and he's created this whole ESG ethos, and if it comes out that some of his companies are doing just the same old crap everyone else is doing, and he's going on CNBC and saying, Nvidia sucks, and he's going on NBC and saying that you shouldn't be shorting Tesla, you should be buying Tesla, when actually in reality social capital only brought Tesla convertible bonds because they didn't want the risk of Tesla. There's stuff like that I just don't like, and he's doing it through this social capital thing. And even Facebook, like he was part of the creation of Facebook. He knew exactly what was going on with Facebook. What Facebook's become isn't a new thing. It's been growing over the past 10 years while he was there. And now he's left. He sits there and goes, oh, yeah, I would wonder what they're doing there now, because they've been really naughty over the past 5 years or so. None of that was going on when I was there. It's like, what? Really? Come on. Do
you not think it's been the perfect storm for him though, with the IPOs being so frothy? There's just no chance of getting an IPO at any kind of decent price. They've been going up 2-3 times before retail can even get their hands on them. And here is Chamath. He's democratizing IPOs. I think that's his words, not mine. And he's bringing IPOs to the people at reasonable valuations. Now, regardless of what you think of the companies, I think they're a lot weaker than the sort of companies that get to IPO. I think there's a tier system, and I think the top tier systems, the top tier companies tend to go IPO, direct listing. The second tier systems probably not ready for an IPO. They tend to go through a SPAC route. So whether you're actually getting a good value company or not, there has been some really good SPACs and some really good companies that have gone live through it. But I mean, I struggle to see how you're going to attract the really, really good companies down that route, which is what I think Bill Ackman is struggling with PSTH. I'm almost certain he thought he would have a deal by now, and his SPAC's too big, I think, is the issue. He's got to get a monster company, and it limits him to about 20-30 companies. That's not a long list to whittle down to nothing. But my issue with Chamath is, And it's not that I dislike the guy. I just think he's peddling himself as man of the people, but he sort of misses the point that he pays 25 grand for a hell of a lot of founder shares. And even if those shares go off at 10 quid, $10, he makes an absolute fortune out of it. Now, if you wanted to be man of the people and you wanted to democratise IPOs, you set up your SPAC like Bill Ackman did with 0 founder shares. Or you set your SPAC up like HAAC did, and they gave, I think it's 10 or 15% of their shares to charity. So yeah, I think that's how you democratise IPOs. That's how you benefit social good. And what Chamath's doing is just being a very good marketer.
It's funny you mention that because that's what he did at Facebook. He was in charge of increasing its user base or user count, and I think that's what he's trying to play on social media as well. And I think because we've seen a side where a lot of people have basically said that he's trying to position himself as the man of the people, when he's really just trying to railroad them into his SPACs.
Yeah, that's it. He knows how to use social media. He created it. He knows how the system works, and he's got himself to the head of it. It's quite crazy. I mean, just as a nice segue there, because we started talking about SPACs, I know you guys, Steve and Zach, are dying to talk about some of your latest companies. Anyone want to start off with one of your SPACs? We'll go through SPACs first, and we'll talk about.
Yeah, I mean, I'm happy to start on. I mean, I mentioned them in the monologue, but yeah, HAAC is one that's really caught my eyes. It's got a decent sized trust of about $500 million, so it's sort of in the middling sort of range of SPACs that are around at the moment. And it's with SPACs really, all you can look at is the trust, the management, and the target. There is no other information out there. There's no point trying to value these things, because until they've got a target, they're essentially worth $10 or whatever's left in the trust when it expires. So HAAC caught my eye because they've got Hemant Taneja in charge of. He's the chairman of the board, and he works at General Catalyst, and they've pretty much got all the best. Their companies are the best of the best. We're talking your Livongos, people like Stripe, Airbnb. It's the who's who of investing, really. A couple of other people on the board that I caught my eye. There's Quentin Clark. He's CTO or ex-CTO of Dropbox, and he was there when Dropbox was a real powerhouse, really. And it was before Google Drive and all the other things that have sort of taken market share off Dropbox. There's Anita Promoda. She's from the Federal Reserve. She's a banker essentially. And the last one was Glenn Tallman. Glenn Tallman is ex Livongo. He was the chair of the board. He took Livongo through the merger with Teladoc for I think it was an acquisition, wasn't it? $18.5 billion. So he's got some real clout in that board. They've released a manifesto with their SPAC, which is quite interesting. I don't think I've ever seen that before. Basically about how they want to sort of democratise healthcare, and they really want to look after the little guy. So yeah, I'm really impressed with this SPAC. I think it's about as good as we can get based on our previous conversations. They've had a link. It's a bit, I don't think it's confirmed, to Colour.com, and they're an affordable genetics company. So it's ticking all the meme boxes. At the moment, the only issue I've got with it's trading about 25% above its net asset value, which it means it's trading at a fair old premium, really.
Yeah, let's just talk about that, because coming from me, I do not go near the SPACs because I simply can't value it. How do you determine what you want to pay for a stack? Just go through the net asset value valuations and tell me, as an idiot, what I should be paying for a SPAC and when I shouldn't be paying too much.
So the vast majority of SPACs raise at $10, and that is their net asset value. So basically what they have to do is they have to sit on that cash. They can spend it for meet and greeting and strip clubs and what have you, so long as they're taking the person they're trying to acquire out with them. And they report that back, and this money dwindles away until and they report this like a normal company. They'll report this quarterly, how much they've dwindled away, how much they've spent on private jets, which they genuinely do spend a lot of money flying around all over the place. But generally, a SPAC is $10. At the end of the redemption, you will get that money back, or a figure that's pretty close to that amount after fees and what have you. So that is called the net asset value. So whatever happens, if that SPAC fails to find a target, you will get your money back, or at least a decent proportion of it. So basically, people call that as kind of like, that is their bank account. So they will stash cash in that SPAC on the hope that it gets some kind of well-regarded / meme company, and it generates some crazy returns. And we've seen it. I mean, the SPAC market is incredibly frothy. I think there's more SPACs now than in all the other years combined. So the only issue with that now is that it's getting to the sort of point where there's probably too many, and you could end up banging your money in $10 in a SPAC that can't find a target.
And that's it, because there's so much guaranteed money in a SPAC from the net asset value, and also from the 25 grand's worth of free shares that the owner just gets as a present. There's a lot of them, and we are eventually going to start seeing, and I believe that we already are starting to see, some really low quality SPACs coming on the market.
I think it's just a case of whether they're going to survive post-merger. I mean, if we take Hyliion, for example, it went up from, I think, $10 to $55, and then everyone's trying to pump it to $80.
Yeah, made a nice penis shape.
And then it went back down to... So it went back down again to about 25, I guess, and then everyone sold. And now I think JP Morgan have said it's only worth...
Yeah, they said it's rubbish, haven't they? By the time that Hyliion's ready to make anything, we'll be doing something else, is essentially what JPM said. So that is damning.
I could have told you that 6 months ago. Yeah. I could have told you. Who wants hybrid trucks? Who really? when we've got Tesla building fucking electric vehicles, who wants a gas-powered truck? It just didn't make sense. Why were so many people going on this stock? And I think there's more of them.
I was going to say, one of the issues that I have with, I think it's both Hyliion and our friend Nicola, is that what happens is, as a SPAC gets older and older and it gets towards its redemption, they tend to look to buy any old shit. And that is the issue with SPACs, I think, is that the longer they go on, the more you should be worried and the less premium you should be willing to pay. Because what you're going to end up with is very, very, very basic due diligence by the founder and the board, because they're still going to get their 10%. I mean, hell, Nicola is probably one of the investments of the decade when it went up to 90, but it just as quickly went back down to not very much, and with good reason. So that's one of the things that you should be careful about, is just make sure you figure out when that SPAC expires and sort of adjust your premium to that.
I was going to say, sorry, I think everyone wants their SPACs to do well, and I think there's a lot of hype mentality around it, especially on stock tweets and even in Discord servers, subreddits and all sorts. And I think part of this is because they've just trying to position themselves close to the NAV, the $10 mark, or $20 in case of PCPS, Bill Ackman's SPAC. But I think there's a lot of misinformation and disinformation as well in regards to SPACs as well. And I think it is a dangerous place to kind of park your money sometimes.
All right, let's finish off with an earnings report from last week. We like to go through a little bit of an earnings report on this channel, and there's one stock that came out last week that I think we've all got a bit of an opinion on. I don't know if we all follow exactly the same lines, but a few of us are invested on it, and that's Bristol Myers Squibb, which is kind of one of our stocks of the week. It's a stock that potentially is a little bit down, but there seems to be some promise in there that I think we're going to talk about, and also some of the famouses. It's got the potential to be a bit of a meme stock as well. So I think, Steve D, you're going to run us down with some of the earnings from last week.
Yeah, so the reason we picked this stock really is that it sort of satisfies a little bit of everything. So it's got a little bit of growth, it pays a good dividend, and it's arguably a pretty good value. So I'm just going to quickly run down what they reported on February the 4th, which was the quarter revenue was 11.1 billion, which is over what was expected, only slightly, but this company tends to be analysed really well. It brought full year revenue up to 42.5 billion, which is no small amount really. It is a lot of sales. Unfortunately, they reported a 10 billion loss in the full year, and this is because they acquired a company called Myocardia towards the I think it was third or fourth quarter that it actually went through. They agreed to basically had a debt tender offer, which is an offer to the bondholders to pay off their debts a little bit earlier. So they reduced that by about 5%. And they also agreed to do 3 to 4 billion in buybacks. So it's quite an interesting report, really. It was ups and downs with quite a shocking headline loss, but when you look into it, it was quite exciting, really. So I was really happy with the figures. They gave some really good guidance as well. They're expecting revenue growth in the high single digits. They're expecting their gross margin, and that's to be 80.5%, which is cracking, really. That's tech level high.
That's big.
For those who don't
big.
know, is net sales minus cost of sales. So the higher this figure is, the more the company will retain for every dollar that's spent with them. So they're expecting to generate 50 billion of free cash between now and 2023, which gives them a forward PE of about 7. So as I would say, it's cracking value. I don't know whether we want to just nip over to Steve W, see what he's got to say about it.
Yeah, I mean, I think you're right in thinking it is good value there. I mean, Bristol Myers is one that, when you look at its balance sheet, it looks a bit kind of weird, especially when you look at the kind of book value on it, because it was kicking around at about 14 billion, I think, for 4 or 5 years and a bit before then. And then suddenly, after a Celgene acquisition from a little bit further ago, it shot up to about 79 billion or something like... Sorry, shot up to 59 billion, which looks kind of great on paper. That kind of book value increase is a fun thing if you're kind of value-minded in the way that I am. I mean, you have to look a little bit carefully at this kind of thing, in the sense that a lot of that's made up of goodwill and intangibles. There was a 79 billion increase on goodwill and intangibles, and there was an increase in long-term debt on 39 billion. So PE is a tricky kind of metric for a company that, Zach was saying last week, he prefers companies that don't have huge amounts of debt. Bristol Myers have added to their debt sort of quite a bit in the process of making acquisitions. So another way you can try and value these, if you're interested, is what's called enterprise value over EBITDA as a measure. So enterprise value basically takes the market cap, the debt, takes off the cash, and gives you a number based on that. So it'll build in the debt, basically, and it'll put it over your earnings before interest, tax, depreciation, and amortization. And that gets you to a number of around 9, which is still pretty low for what it's worth. I mean, comparisons, roughly peer group for these guys would be someone like Merck at just over 11, Pfizer at just over 12, AbbVie at just over 12. So there's still a kind of nice lowish number there for the kind of group that these things are in.
Yeah, and so this year, or last year in particular, 2020, was quite a mixed bag for the management. They've made some interesting decisions buying Myocardia. Myocardia is, from what I remember, is it was a heart protein detection company, or at least they're trying to create different therapeutics around ACS problems in the heart. And while that company doesn't really have a lot of product at the moment, it's supposed to have quite a good pipeline for the drugs for all the ACS things. And also the Celgene merger was quite an interesting one, because it was quite a shrewd deal that they made with the Celgene merger. Most of the time when these companies make mergers and acquisitions, which is what Bristol Myers Squibb is, it's a mergers and acquisitions company. These big pharmacology companies, they make their money by buying new companies and then reaping the benefits out of them. Celgene was a very promising company, but it needed to gain approval for 3 drugs in order to make sure the merger happened. And what was quite interesting, in comparison to say what a normal merger would happen, is that BMY had absolutely no risk on the table. If Celgene didn't make the 3 FDA approvals, then BMY was able to just walk away without paying anything, which is quite rare actually in this sort of business. So the management have made quite an interesting, good move in that situation, but we're not quite there with myocardia yet as the new drug pipeline there. However, this new amount of money, I think it was 6.8 billion they were left with of extra spare cash. Are they planning on doing anything? What do we see Bristol Myers doing with that cash in the near future? Anyone know?
Yeah, so near future they're going to use it to buy back the stock. Essentially, they're going to use between 3 and 4 billion of it to buy back, which is quite a large chunk of stock. Really, that's dollars, $3 to $4 billion of stock. And the stock is only $50, $55, $59 at the moment anyway. So they're going to buy a large chunk of that stock back. They're also raising the dividend as well, which was quite nice to see for dividend investors.
Which I also love to see. It would be nice, but I don't think there's anything too specific that they've talked about in their pipeline yet for using that money to buy anything else. So yeah, most of the cash seems to be going back into shareholders' hands, which I personally love. I think companies should pay back to their shareholders, especially when they're quite mature companies. That's where I kind of like to look at. And I know not everyone agrees with me on that one.
Well, one of the things that I think is quite exciting about that is that I'm not overly bothered about having the cash in my pocket, because I think that Bristol Myers can make a much better company with $50 billion worth of free cash. So whether that is, I mean, they've got a pretty large debt pile to pay off. They could get that paid off. They could pay half of that off and then have half the free cash flow to, and this is what I think is most exciting, is to go and acquire again. Go and acquire a genomics company is something that we think that's probably lacking from their portfolio. But the test is that really they're going to be generating this cash for quite a while. The patents on the vast majority of their drugs are fairly long. There is one of the blockbuster drugs which is ending in 2022. I think Steve's shaking his head, so he may know exactly. So that's going to be a killer. But the pipeline has a lot of stuff in it as well, which is coming along, which they're hoping to supplement revenue with. So I think they're going to be generating free cash for quite a while. Now, whether that goes in our pockets via dividends, via buybacks, or whether they go out and acquire more great companies like Celgene, I really think it's one to watch.
Yeah, so when I was sort of significantly further back in my kind of investing career and I was thinking about how to analyse stocks and that kind of thing, Steve D always told me that he thinks mining stocks are easy, because basically what you have to do is work out how much stuff they got in the ground, how much that stuff sells for, and how much it takes to pull it out the ground, more or less. And I kind of think that pharma companies like this are sort of similar, although they're harder to work out, basically. So you want to know what's in their pipeline, how successful is it likely to be coming out of their pipeline, and what's the current market cap on their company. I mean, those are harder things to work out, in the sense that cancer drugs don't have a commodities price that you can look at and work out that it's going to go up or down or so on. But it feels like for Bristol Myers, I mean, all of their stuff is out of patent, I think, by the end of 2028, having a bit of a look. But they do have what they're talking up a lot as a really strong pipeline to follow through on that kind of thing. So they're talking about significant sort of 40-ish, $42 billion of revenue coming out of their kind of pipeline drugs, which is important in a company like this.
And it's most important, especially for the people that are following the sort of meme and popular stocks at the moment, is that it's quite a big part of ARK Invest genomics portfolio as well. We all take a look at ARK Invest daily buys, and BMY very recently has been quite heavily bought on those, mainly probably because the price has gone down quite a bit recently, and they're just sorting out their weighting. But we mentioned this before. There's a lot of big pharma companies and value plays in the ARK Genomics ETF, and Bristol Myers is one of them. And Bristol Myers is one of the ones, like Roche, that is getting bought quite a lot. and actually not being sold.
Berkshire do too.
Yep, Berkshire's another one. Warren Buffett's buying it, Kathy Wood's buying it, like everyone in between, like us, is kind of buying it. And we've all said a lot of really good things about it. They've got cash on hand, they've made a really nice acquisition, the drug sales are up on stuff like Opdivo, the pipeline looks really good, and the share price is just going nowhere. I mean, like 5 years ago it was around 63. When I looked earlier today it was at 60. The dividend's going up. It's gone up by about 10% a year for the last couple of years or so. But all the kind of good news, we all like this stock a lot. And there's lots of things to like about it, but none of them seems to move the damn price at all. I mean, other than slightly down.
Well, yeah, that's it. Why is it not moving? No one knows, especially as if all of these great investors love this stock. Go ahead.
I was just going to say, when I started buying Bristol Myers, it was just prior to the Celgene merger, and it wasn't really even on the table. Bristol Myers as a company was pretty much finished, and the investors were holding on in the hope that it got acquired itself. And the rumour was that just before Celgene actually was acquired by Bristol Myers, was that Pfizer was going to buy Bristol Myers. So the investors were holding on for the Pfizer merger, and then when the Celgene merger got announced, the initial reaction was like, oh no, we didn't want to hold you, we just wanted the money. And also, that's a lot of money for Celgene.
Well, they did pretty good with the Celgene, and to be honest with you, all these mergers in the pharma world always get announced. I mean, AstraZeneca is constantly trying to have is batting off Pfizer, actually, because Pfizer seems to just want to buy everyone at the minute. Bristol Myers was obviously a target as well. That just seems to be how the pharma world works. Everyone buys everyone, and it's a race to the top on that one. I think that's also how ARK Invest sees all the genomics wars going. We've spoken about that before. Okay, I think we'll end it there. That sounds like a pretty good point to end it out at about 45 minutes. Thank you very much for everyone who's made it this far. Let us know in the comments below what you think of Bitcoin, what you think of ARK Genomics, where you think that's going. Leave it in the comments below the YouTube video. Feel free to listen to us on Apple Podcasts, on Google Podcasts, and Spotify. The links are also in the description below the video, and thank you so much for listening on Spotify and Apple. That's doing really well, surprisingly well, when we looked at the statistics this evening. Thank you very much for everyone for watching, and we hope to make this much better every week. We're always trying to improve, so leave us any suggestions, and thank you very much for the third time.